All right. Hello, everybody, and welcome to today's webinar. I am your host for today. My name is Kieran Newton. I am an editor here at IBISWorld. You might also know me from the IBISWorld podcast. It is snowing outside in New York City right now. I hope everybody is staying warm on this February afternoon or morning if you're over on the West Coast. Today's webinar is going to be part 3 in our Flying Blind series called Be Alert as the Credit Cycle Grows Old, Opportunities and Challenges for Commercial Lending. And the two fine folks who are going to be running today's webinar are Dr. Rick Buczynski, who is IBISWorld's chief economist. Hi, Rick.
Hello.
And we are also joined by Dev Strischek, who is principal of the Devon Risk Advisory Group and formerly the senior credit policy officer for SunTrust Banks. So hi, Dev.
And hello to all of you.
A few housekeeping things before we begin. We are, of course, recording today's webinar, and so that will be available to you on demand afterwards. We will be sending that out along with a link to the accompanying white paper that Dev and Rick have been working on very diligently over the past couple of weeks. We're also going to have some time at the end for Q&A, so if you have any questions as we go through, go ahead and submit those through the GoToWebinar app, and potentially we will see if we can get to those. But for the moment, I am going to turn it over to Rick, who's going to take it away.
Well, thank you, and thanks for joining us. And speaking of snow, from snowy Washington, D.C., and Dev, I think, from snowy Atlanta. I guess it's been that kind of a winter, and we're expecting more. I just wanted to mention a couple of things before I get this thing rolling. This white paper that Kieran mentioned, you'll be emailed links to that, so you'll be able to find it. There's quite a lot of detail in this presentation today, and some of it we're going to kind of skim through. Just realize that we're going to be, if you look at the white paper, it's going to be embellished and everything is going to be easy to follow. It did take us quite a bit of time to put together the white paper, so make sure you check that out. And the last kind of reminder is that RMA has been kind enough to offer a CRC credit for your participation today, so you can contact your RMA rep. And so here we go. We've got several bullets on this agenda today, and the first two are going to be handled by Dev. He's going to go through just some fundamentals about cycles and maybe where we're at in this cycles. And then he's also going to look at some industries that are historically vulnerable to recessions. Being a retired banker, this is going to be from a banker's perspective. Then he's going to hand things over to me, and I've got about 3 sections that I'm going to go through today. I'm going to try to identify the most resilient American industries to start off and alleviate some myths about the American economy. Trade has been a huge issue over the last, almost 2 years now. So we're going to turn our attention to risk opportunities and also the last session being debt, and more debt. I'm going to have to go through this session pretty quickly, but I think it's really important. So with that, I'm going to hand it over to you, Dev, and I'll just click through these slides.
Okay, Rick, thank you. So you probably, if you've been around for a few years, for those of you who might have just joined banking or finance, you probably hear from people that this is a great recession and it was worse than the one before. What that is prima facie evidence that indeed we do go through business cycles. We go up, we go down. The challenge is to find borrowers who are able to figure out how to make it. If you think of your borrower sitting there and this economic bubble, environmental bubble that sits around it, it expands, it contracts, and the key is you have to find borrowers who are able to survive it and actually grow their business, make money, and have the resilience to go up and down with it. So let's take a look at the 4 classic phases of a business cycle. So here's the picture. We've got early expansion, early contraction, and late contraction. And while this seems to be a popular guessing game, when is the expansion going to finally turn? Let's figure out what kind of borrowing activity goes on. In the early expansion, think of this as recovery. You've got a group of borrowers who have been kind of resting on their oars, hoping that the tide will take them onto the beach. But what they've been needing is going to be money to prime the pump, so to speak, the working capital, borrowing it in order to buy inventory, the inventory being sold to customers, and induce them to buy it. Of course, the credit terms offered are hopefully going to be generous enough to get them to finally start buying your products. Meanwhile, more than likely, fixed assets, plant and equipment have been sitting with a lot of deferred maintenance, and so there's going to have to be CapEx to rejuvenate that stuff, and not to mention borrowing enough to perhaps not just increase the size of the warehouse for the additional inventory, but also more trucks, delivery trucks, and so on and so forth. The benefit is that interest rates are relatively low during this period of time, so it's easier to borrow. As we segue into late expansion, and boy, we've had a late expansion in this recovery from the Great Recession, what companies run into is they find that they don't get as much bang for the buck. There's an old rule of thumb that generally industries can get $2 of sales for every dollar of assets, but that begins to slide down, not quite as efficient in converting working capital and fixed assets into sales. So they need more and more funding to continue the sales growth. And of course, they put on more capital expenditures in order to increase the capacity. And so now rates start rising, and that eats away at the profit margins. And then as we slide into early contraction and late expansion, it's anybody's guess when we finally are going to tip the scale, so to speak. Many people talk about the next year and a half. We go into early contraction. And so what's going on here is that your customers are experiencing difficulties. Maybe their sales are going down. Maybe they don't have as much cash. And so they're going to be looking for even more generous credit terms. And so what you start seeing is instead of 30-day terms, you're getting into 40 and 50. Meanwhile, the company decides to cut back on its inventory. Maybe instead of having 12 products, they cut back to 7 or 8, the ones that are still selling. And then finally, as we go into late contraction, otherwise known as recession, what happens now is that companies need to just cover their operating nut. So whether it's a big box retailer, whether there's one customer in the store or 100 or 1,000, you still have to turn on the lights, you still have to turn on the heat or the air conditioning, and you have to get through this period where your customers' credit is going to be much weaker, their ability to spend much more diminished. And so what begins to happen is you start eating your own lunch, so to speak. You start liquidating inventory and not buying any more inventory, hoping that will cut down on some of your other SG&A expenses. But keep in mind, credit cycles don't hit everybody the same way. I'm reminded that Texas during the Great Recession hardly even experienced the recession. And of course, what you have in the way of commercial and consumer exposure, banks that are more consumer oriented felt it much more, particularly in their mortgage portfolios. So where are we now? As I said a little bit earlier, we're probably getting near the slowdown period phasing. We're at the top of the late expansion boom, and we're just looking over the edge. But nobody knows for sure, and that's what makes it so much fun. Next slide. So when you look at those that are highly susceptible, notice that construction is at the top of the list. And when you start looking at the other things, well, you're building houses, you need furniture and appliances, you need plumbing, you need gypsum wallboard, you need lumber, you need concrete. You notice that a large number of the items on this list are all related directly or indirectly to construction. And so if you're looking for things to think about about, well, maybe we ought to cut back on our exposure here. Clearly, this list is a good one to start with. Meanwhile, on the less susceptible, I've always noted that when it comes to state, local, and federal government, thin or thick, they keep on building. So if you've got customers who are in the construction business, particularly for government, they should be in good shape. Note the beverages are at the top of the list, and so you may not be buying Grey Goose vodka, but there's still pop-off out there. The agricultural chemicals stand up pretty well. And again, these would be a good list of, you're probably safe with these companies. And clearly grocery and food services. You may not be buying the $4 double fiber bread, but you still have to buy a loaf of bread for the family. So when you look at this list, this represents a list of types of businesses that would be probably more desirable to have in your portfolio as we slide into the recession. Next slide. So if you haven't heard about the Amazon effect, just go to your local shopping center and notice how many stores are closed. And what is so remarkable is how much stuff people are buying online. I'm a big fan of the Big Bang Theory, and at least 10 minutes of every show is dedicated to the group of them sitting around eating takeout. Of course, it looks like they still go and pick it up, but I'm sure they're ordering online. But the fact is, with the advent of the smartphone, we do a lot more with our fingers than we ever did by walking or driving to the place. And so, as the slide indicates, there's no end to this. And then there's the junk bond. One of the blessings or curses of this great recovery from the Great Recession is that it was cheap. Interest costs have been really, really low, but also so have returns. And so investors looking around for something that paid a little bit more naturally gravitated to junk bond companies. So these are companies triple B and worse. And what they are attracted to are retailers because there are no receivables. And so inventory sells, credit card receivables turn in a day or two. You've got this enormous gross cash flow. And I say gross because the reference here would be to EBITDA being the typical measure. And even though EBITDA is not really a measure of cash flow for investors, is good enough for their purposes. And so consequently, retailers and secondarily the whole computer market have been ravenous in their pursuit of cheap debt, and the consequences have been genuinely scary. Next slide. So as you begin to look at the closures, notice from 2015 to 2000, we have now exceeded the closures at the height of the Great Recession. And the scary part here is there's no end to it yet. So think about Toys R Us and Sears. And the problem is that many of these stores are located in shopping centers that have restrictions on the lease that make it difficult for the owners to find replacement stores. Rick, next. So you all may remember Circuit City. You might want to paste a picture of Best Buy on here. If any of you have been in a Best Buy lately or haven't been in for a few months, go on in. You'll find that the CDs and the DVDs have disappeared, and there's a lot more space. And they're now selling appliances, kitchen appliances, over on the left side of the store. The point is that as a Best Buy goes down, there goes a lot of foot traffic. And so as you start looking at your commercial real estate loans, as one big box retailer after another goes out of business, that impacts the foot traffic in that particular shopping center and hurts everybody else. So clearly, you ought to be checking your commercial real estate exposures, your shopping centers, who are the major tenants, and keeping an eye on the next round of bankruptcies. Also, don't forget about FASB. Lease capitalization, it kicks in at the end of this year for publicly traded companies after December 15, 2019. Guess what? The lease liability goes on the balance sheet. And so you're going to have a lot of tenants who are going to be looking for shorter leases so as to reduce that lease, that capitalized lease expense. So what's a banker to do, having just done a 10 or a 15-year commercial real estate mortgage on an office building and was assured initially at inception that all of the lessees were in there on 15 or 20-year leases, and unbeknownst to the commercial real estate lender, you're now beginning to see people coming, lessees going to the lessor and saying, you know, I really need to bring down that lease liability. So how about a 3-year lease, or how about just a month-to-month lease? Lease capitalization is going to be very, very impactful on commercial real estate. So Rick, back to you.
Thank you very much, Dev. I'm going to try to identify some interesting industries that you may want to look at and make sure that you're positioned properly in them as we are creeping towards the end of the cycle. My first chart here is kind of a little background. I think a lot of people don't recognize that we've had some interesting trends, in manufacturing. Manufacturing is actually at an all-time high. A lot of people don't realize this. This red line, by the way, is when the Great Recession started. So this line here is manufacturing output, and this line down here is going to be manufacturing employment. And you can see how manufacturing employment took a long time to recover, and still hasn't recovered, to pre-recession times. And you can see how long it took for this recovery to take place in terms of manufacturing. There's a lot of elements to this issue. Most of it occurred because of automation, although productivity gains have stalled in the past decades. We've all heard the sad stories and the political stories about job losses to robotics, and in particular of late, overseas outsourcing. But, there's something out there that are called super sectors, and these are good sectors to lend to even when you have an uncertain economic environment. Now, there's a great study done by Brookings. It's only a couple of years old, and they update it. So once you get this presentation, you should be able to Google it and get some more information. But they define super sectors. And by the way, this meshes up with a lot of IBISWorld research. That's why I kind of put it in here as kind of validation for some of the things I'm going to be saying in a couple of minutes. But super sectors employ a high proportion of STEM workers, science, technology, engineering, math. And this is a big wow factor because they generate about 80% of the new patents in America and spend almost 90% of the total R&D. There's another wow factor, is that the super sectors generate a big proportion of U.S. exports, about 60%, but they only represent about 10% of the nation's employment. Wow again. So I guess the call to action here is target them. It's that simple. And here's a long list of them. I can't go through all of these today. Check out the white paper again. But you can see there's a lot of them in manufacturing. I'm going to get back to this when I talk about trade in a couple of minutes. But you see a lot of them in manufacturing and a lot of them on the service side. So these are some of the super sectors. Check out the white paper. Compare to your portfolio or some of your business plans or some of your risk models, and see how this fits in to your footprint. Let me shift over to trade, and I'm going to kind of refer back to some of the super sectors here. Here's just a little graph that shows exports of goods. These are goods, and you can see that many of these are in those super sectors. Capital goods, CapEx spending, industrial supplies. These are intermediate goods, stuff like chemicals. These are very, very important, and they have grown. So our trade happens to be quite concentrated on the export side, where the winners are in intermediate goods and capital goods. These are generally high value areas. Now, here's something, I haven't taught economics for almost 40 years. If I was to teach it again tomorrow, I'd ask this question. How does America stand in terms of its service exports? And here's another, like the last chart, this is just another share. And we always run surpluses. They don't make up, they don't totally compensate for the deficits that we have on the good side, but we are running surpluses. And you can see a lot of these are in the super sector. Financial side, international property, intellectual property, other business services. Transport is also very important, including logistics. But one thing people don't realize, look at this. Our leading foreign exchange earner on the service export side is tourism. Travel and tourism. It's number one. Now, the caveat here is that during bad times, this stuff goes away really, really quick. It's very, very correlated to the cycle. Because if you remember from past webinars, we talked about discretionary versus non-discretionary goods and services. Travel is highly discretionary. This kind of meshes up, Dev, with some of the things that you were talking about in the susceptible and not as susceptible, because on that right side of your slide, you had a lot of things that were everyday eating, drinking. So this fits in well with what you were saying.
Are you around to pop off?
Yeah, that's right. Hey, I'll be at your bar. So everybody should know that our leading trading partners are the ones that are closest to us. And these are exports. So NAFTA, Mexico, Canada, Asia Pacific is very, very close behind. China is a big part of this, and Europe. We have Europe as well, and then we have Latin America, and then the rest of the world. So I guess the call to action is pretty simple. Know what your borrowers are selling abroad and where are their principal markets. It's just your basic homework, and actually make sure if they understand what they're doing in terms of their clientele that are exposed to overseas sales. What is it critical for? Everything. From a policy side, risk management, business strategy, from the origination side of the business, underwriting for approvals, pricing, and other terms. So this is just something else that you need to have your analysts and your strategists look at when they're making decisions, both for the long term and also for the short term as we approach the end of the cycle. So to kind of summarize this, there are two major ingredients. Trade frictions always flare up during recessions. But now we have something else. According to several surveys, and we mentioned a couple of them in the white paper, we have increasing populist trends worldwide. America has no exclusive purview here. So this means that trade-dependent borrowers are more at risk now than during previous cycles. So where do we go from here? Let's start at some of the basics. Understand your clients' overseas exposures. Here's just one of several charts that Dev and I have in the white paper. And it's really exports as a share of total American industry revenue. So the higher these numbers are, the greater exposure they have to their revenue and their sales to overseas markets. You can see that agriculture is here, and agriculture and autos always seem to be in the crosshairs of protectionism. About 35 years ago, I ran a conference with the old Wharton Econometrics in Hong Kong, and we were talking about these very same issues, and we're still talking about them now, how things don't change. One thing you have to notice also is that a lot of these capital goods that were on the super sectors, they happen to be very susceptible to downturns. So you have to kind of be careful with these and make sure that you understand your obligors and are your obligors prepared. So the call to action here, know your borrowers' relative exposures versus, domestic versus overseas revenue. And this should be a driver to a lot of decisions that bankers make. I'm not going to go through this chart in detail, but you'll see it in the white paper again, and you can notice that these are the key industries most susceptible to downturn in exports, and obviously transportation and storage are particularly vulnerable. So put this on your kind of watch list, as well as some of the other industries that Dev had mentioned. Here's a subject area that I've been talking about for it seems like decades, and it's debt, and more debt, and the rising cost of capital. You know, since the Great Recession, I mean, look at the numbers. This is global debt from 97 trillion to 169 trillion by 2017, and it hasn't stopped either. And in the case of the United States, debt has surged on all fronts, and I'm going to talk briefly about all three of these. It's surged on the government side, on the household side, and also on the corporate borrowing side. So the first chart here is the U.S. federal debt. So this these bars here are the federal debt in trillions, and this line up here is the percentage of debt to GDP. Now, if you compare, this red line shows here's pre-recession. Look at how much this debt has gone up. A lot of it is due because of the stimulus package in these areas, and now we have, while the economy is growing, we have curiously extremely aggressive fiscal policy. And if you want to add to this, and I don't know where some of you people are stationed, but some states have a tremendous amount of debt. But as a whole, if you add another 10% for state and local debt, these lines all, you know, tend to rise quite a bit. Then we have household borrowing, and it's really changed its complexion since you know, the Great Recession. Here, this line is student debt, and this line here is auto debt. And I guess the bottom line here is make sure that you pay attention to your auto loan portfolios. 7 million auto loans are more than 90 days delinquent now. This is a record. This came out just, I think, a week and a half ago, Dev, in a Federal Reserve Bank of New York report. But the other issue, too, that's been kind of bandied around for a while is that a lot of these student loans, that's this top line, a lot of these student loans are actually being held by parents and grandparents. So think about this in terms of concentrations and correlations, you know, between student loans and perhaps consumer spending in general, particularly in this demographic of older people. I think people like us, Dev. Here's my last slide on debt before I get to a conclusion. This is corporate debt. Same kind of numbers that we had in the previous chart. So we've got the debt in trillions, and we've got the debt as a percentage in this, you know, on this line here, debt as a percentage of GDP. And once again, look at how much it's grown. It's grown quite a bit. Now, Dev had mentioned this in terms of, you know, some of the subprime loans. So keep that in mind, because a lot of these are subprime, and this maybe this is our new subprime crisis. Nowhere near as bad as we had in the Great Recession, but still something to be concerned of. So what does all this mean? Well, look, here's kind of the call to action. Well, we know that there's a concept in economics called crowding out. So if the government is borrowing and households are borrowing and corporates are borrowing, maybe not for capital expenditures, that can kind of crowd out. But you also have to beware of industries like small retail, mom and pop shops with thin profit margins, firms that carry heavy inventories, and as Dev mentioned, construction related. A lot of this stuff we actually talked about in previous webinars. That being said, Dev, I'm going to let you land the plane for me.
Okay, Rick. So when I started out, I mentioned how business cycles go up and down, and clearly they're hard to predict. For example, Rick, if I'm not mistaken, this particular expansion is now over 10 years and the longest one in the post-World War II economic history.
Right.
So after 10 years, we're at the top of that recovery. Both Rick and I have mentioned some industries that do better than others, but this changes from year to year. You don't want to get trapped the way the French did after World War I and build the Maginot Line thinking that you're going to have another war of trench warfare. Things do change. I mentioned smartphones. Think of the impact of smartphones on something as simple as alarm clocks, wristwatches, and even small computers. And at the same time, because of the great length of time and the Fed keeping interest rates low, investors and lenders really piled into the leveraged lending market. As one indicator, 70% of the debt issues in the second half of 2018 had debt to EBITDA ratios in excess of 6. And that is extremely high. And there's no sign of it changing either. So Rick laid out for you what's going on in terms of consumer debt, and it's not getting any better. We're talking now 84-month car loans. Some are going out to 8 years, and that's simply to spread that payment out over a longer period of time and make it lower. And unfortunately, we don't have consumers with enough money to buy the output. So watch out for the car industry as well. So you've got your pecking orders of what we'll call resilient and not so resilient industries. Go out there and start positioning your portfolios accordingly. And of course, retail is the big elephant in the room. Rick?
Kieran, do we have any? I think we're running a little bit late, but do we have time for a couple of questions?
Yeah, sure. Let's go ahead and I've got a couple of them here. Okay, here's one that came in talking about debt, but wanting to get a little bit more specific. The question reads, what about leverage lending? Are corporate borrowers that are basically subprime still a big issue?
Yes, yes. It's funny. Banks are always looking for borrowers, and particularly borrowers who need to borrow. And when you go south of triple B into junk bond type borrowers, it is a serious problem. And what a surprise that so many of the retailers were triple B or worse. And again, this is driven not so much by the banks, but by other non-bank lenders. That's another big change since the Great Recession. We bankers have been giving up C&I lending for a long time, and in this market where non-banks compete with us, insurance companies, it's very, very serious. And you may think that you're safe, but what if your particular borrower's operating in a shopping center where 2 or 3 big box retailers go out of business? The ripple effects are pretty critical. Rick?
Yeah, I mean, I agree. I think that this is something that we all have to keep in mind. There's been several papers published that we refer to in the white paper that discuss this issue of debt, and there's just a lot of holders out there that don't realize, banks that don't realize that they're indirectly holding a lot of this debt. Kieran, do we have time for one more question?
I actually think we are going to cut it there, Rick.
Okay.
But I wanted to thank everybody who also sent in other questions. We did get those, and if we didn't get to your question, your CRM will follow up with you on that. Also, a couple of questions have come in about whether the presentation itself will be available, and my apologies, I did not mention that up top, but yes, that will be coming to you all shortly. Thank you all for joining us. Dev, Rick, thank you so much for digging into these down cycle trends for us.
You're welcome. Thanks for coming, everyone.
Okay.
And the white paper will be available. It should be heading out to you all very shortly, so keep an eye out for that. You'll be getting the link to that along with the on-demand YouTube link, so we'll be sending that out. For more of IBISWorld's insightful analytical content, you can check out Industry Insider, which is over at ibisworld.com/industry-insider. Insights like Rick and Dev's here from our analyst team. So go check that out. That is also where you can find the IBISWorld podcast, which I am a regular host of, if you want to hear more of my voice. We just put up another episode today talking about some of the challenges facing the dairy industry. So you can go ahead and give that a look. But other than that, thank you all for joining us. That concludes today's webinar, and we will see you next time.